Good morning, John Hutchinson with Traders Reserve. I am pre-recording Breakfast Club today, Monday, March 9th. Uh, Frankly, in one of those moments of forgetfulness, I forgot I had a dentist appointment first thing this morning. So I am going to walk through Breakfast Club for today and leave it for you. A reminder that we will be off for the remainder of this week as we get ready for the IBL AI Wealth Conference taking place at the end of next week. But I will be with you next Monday, March 16th, for our next Breakfast Club. So let's get to the details. Obviously, the big news, oil. As I said last week, watch oil. As oil goes, the markets will go in the opposite direction. That continues to happen overnight. Oil reaching $120 a barrel. Markets are down pre-market. So just a setup for today. Again, a reminder of what's not just what's happening, but some steps you can take to think through the problem. The underlying, and there's one question which I'll share with you at the end. It's the only question that matters as it relates to everything. So again, futures are down. Oil, West Texas oil hit 119. Brent crude hit 120 or 121 overnight. The other issue is the rising 10-year yield, which is now back to 4.2%. It had been below 4%. All of this pressuring stocks. The weak jobs report. The weak jobs report will get a little bit of a pass, not because markets don't care or because the Iran conflict is more important, but because there's some issues that affected the numbers. Those issues being there was a strike in January, which negatively impacts jobs reports. We had extreme weather, at least in Detroit we did, but we had extreme weather throughout the Midwest and the Northeast in January, February. So that will affect hiring. So the numbers may be temporary. This may be an outlier report. We'll find out when the next jobs report gets released at the beginning of April. As well, those numbers, the negative 92,000 jobs will likely get revised closer to positive. It's not necessarily going to swing from negative to positive, but if that jobs report is, instead of being negative 92, is suddenly negative 20, that would be a pretty significant and solid revision. And it may just be a one-time negative report. So much as I stressed with the PMI, the Purchasing Managers Index report for manufacturing, the prices paid form a piece of that last Monday. Sometimes those prices paid can be outliers. It can be a short-term spike, and then the prices come back down. All of that could be due to a number of factors, including tariffs, weather, things of that nature. So a little bit of a little dash of hope, if you will. It does not change the fact that employment is weakening, but really the biggest issue right now is oil. The $100 a barrel threshold is significant. It negatively impacts the entirety of not just our economy in the US, but the global economy. And it hurts consumer confidence, which in sort of a roll down the hill problem. When consumer confidence falls, consumer spending falls. When consumer spending falls, GDP falls, et cetera. So on one hand, the temporarily topping $100, we can overcome that. If oil prices remain elevated, that becomes a structural problem for the economy that is not priced into the market, even at current levels. On the other side of it, the hopes that this will be temporary, the claim that the U.S. would start to escort ships, tankers through the Strait of Hormuz, Iran claiming that they would stop firing missiles at their Middle East neighbors, which didn't happen. They continued to do that over the weekend. And essentially anything that can stop or prevent Iran from threatening oil in the Strait of Hormuz will get tanker ships moving again. One of the other key factors affecting the price of oil right now is production. UAE, United Arab Emirates, Iraq, and Kuwait have all announced production cuts, not because of the threat from Iran, but because they don't have any place to store it. So that's an entirely different headwind in getting the supply of oil moving again. So this is a two-part problem: production and supply. Supply as in transportation. And if either or both of those are removed from the equation, you should see a fairly healthy recovery in the stock market. You should see oil prices fall back down to the $80 to $90 level. They may stay, oil prices may still remain elevated. That will still have an impact on stocks, on the economy, but it certainly not at the level of 100, 120, even as some have forecasted, $150 a barrel. So the biggest hope is let's get that problem solved, and we'll be able to start to recover. As we discussed last week, there are really three scenarios here, and this comes back to the biggest question, which is how long does this last? That is the only question that matters. The less time it lasts, the better. The longer it lasts, the worse. So on the base case, the short term, 1, 2, maybe 3 weeks, if the U.S. Navy is able to escort tankers, if production is able to get back to normal levels, if supply is able to move, that would constitute the short term. And the moderate case is somewhere between 2 and 6 weeks. Again, gas prices locally here would be elevated for a period of time. Of course, we also know that as soon as we get to Memorial Day weekend, everybody's going to slap on 50 cents to gas anyway. But we don't need the extra 50 cents tacked on. So the sooner that this issue can be solved, the more stability we have as it relates to the economy, to stocks. The worst case, which is where essentially what is being priced in at the market level, is that this could be an extended problem that goes beyond 2 months or longer. I've seen as much, not expectations, but claims that it could last as long as 6 months. And that defies everything that has been stated by the U.S. administration about the Iraq conflict, keeping it to maybe 4 weeks. But at any rate, this now creates a new problem for the Federal Reserve. And the Fed is, as I said last week, they're now stuck in between the rock and the hard place, right? On one hand, rising oil, the weak jobs, these are reasons that the Federal Reserve could justify rate cuts. On the other hand, inflationary pressures continue to remain. That pushes the math out further for the Federal Reserve. So we now have a new number one issue affecting stocks. Doesn't matter what you're trading. You have to be more selective in what you trade over the next at least several weeks. Small caps are getting crushed much more heavily than tech or the S&P or Dow components. So there's certainly opportunities in oil. There may be opportunities in basic materials. There may be opportunities in restaurants, strangely. But fast food. But most importantly right now, the Fed was originally expected to cut rates in June, maybe as late as July. There was not an expectation for the Fed to cut at their their March or April meetings. The March meeting is coming up in 2 weeks, and there was no expectation for a rate cut. We will be interested to see how the Fed views the balance between inflation and labor. That will be a key and critical point. That being said, still no expectation for that meeting to end or result in a rate cut, but it is the first policy meeting for the Fed funds future rates of the year, and that will stabilize or destabilize market expectations for rate cuts. So if the Fed comes out of that meeting and is still projecting the potential for one or two rate cuts in 2026, that would still meet Wall Street expectations. That's the key. That is actually the only outcome that really matters from the Fed meeting upcoming here in March. When those rate cuts happen, different question. That's for the betting markets, for those of you who like to play in that arena. But more importantly, for our purposes, what we want to see is the Fed is still committed to reducing rates over the remainder of the calendar year. If that stays true, again, potential for a solid or strong rally in the stock market. The underlying new danger, which the Fed may or may not address, is stagflation. So persistently high prices and lower economic activity, but we don't have the lower economic activity. Retail sales came out last week. For the statistical remove automobiles, gasoline, and building materials, retail sales were a beat, and that is consistent with a number of retailers like Ross Stores and Best Buy and Abercrombie and Fitch, who all reported earnings last week that beat expectations. So consumers are still spending, but that spending was pre-oil, pre-spike in oil. So the next 1 to 2 months, that's why I say, again, the sooner they end this conflict, the better on the economic and market side. The longer it goes on, the more difficult everything becomes. So keep that in mind. But I still think that rate cuts are a little bit further away than everybody is projecting. So your playbook, your week ahead right now is not easy. I can't stress this enough. The hardest thing to do is to decide if you're holding stocks, right? We're holding 15 positions right now in the AI2 portfolio. The most difficult decision is what to do. Could I just shut that whole portfolio down, take a reasonable loss, and then look to reallocate capital when things get better? Yes, I could. But here's my problem. And with stocks that you hold, you may have the same problem. The current shock in the market is not a fundamental, nor is it a true economic shock. It's a temporary shock. So if you're looking at your stocks, do I own stocks that are fundamentally sound, stocks which are outperforming their earnings expectations, stocks which are outperforming their revenue expectations? If that's the case, selling may be the wrong move because you're creating a scenario where you move from losses here to gambling on gains somewhere else. That is a difficult balance. It's a position that I don't like to see people following us in. It's the hand that we've been dealt, so we have to manage it the best we can. When I look at the aggregate performance, I'm still up on the year, and being able to take a small loss temporarily, that hurts. The one thing I want to avoid is letting that small loss run deeper. But at the same time, at some point there will be a move back higher. And many of the stocks that, at least that I'm holding in the AI2 portfolio, those are stocks that will significantly outperform on a rally. So that's why I talked about the averaging down concept last week. So look for opportunities where if you have the ability to sell calls, sell reasonably out of the money and keep them short. Don't go too far out in time. That's an option. That's a choice. You can absolutely choose to sell your stocks and then hope to get in, if you can pick the bottom or catch the market on the way back up. But the other underlying issue has been the rolling correction that we talked about last week in the NASDAQ. And is this simply just if markets are rolling down now and then recover, is there just another rollover point somewhere in the next several weeks or months. So I really think we're headed for a relatively flat market this year. So if as soon as we can build a lead, we want to keep as much of it as we can. The Iran conflict was a surprise. Um, they were talking. Uh, so the difficulty last week is what's really going to happen. And most of the market shock is centered around oil. If oil gets back to stability and the conflict remains largely an air war and a diplomatic, so to speak, war, the market won't care about that. The market only cares about the price of oil, supply, and transport of oil. If that's solved, this market will rebound. It may not necessarily, it's not going to go to new highs, but the market will recover most of its current losses from the last 7 days. So, with that, look for potential trades in energy, ExxonMobil, Chevron, the XLE, if you're trading ETFs, the RSP, the equal weight index for the S&P 500. Can also give you a little bit of a buffer. It will still likely pull back, but it should not pull back as much as the overall S&P 500. So because it's equal weight across all of the stocks in the S&P 500, you can when some of those stocks start to rise back up, you can get a little bit better boost from a recovery there. For artificial intelligence, the long game hasn't changed. The CapEx expectations haven't changed. Earnings outperformance hasn't changed. The AI build out is not slowing down. In fact, there was a story today about Meta buying out a facility that Oracle and OpenAI decided not to continue to build out. So there's nothing changing in the underlying structure for artificial intelligence moving forward. There are increasing pressures or will be increasing pressures due to energy demands, energy costs, but those can also be temporary. So with that, that'll be Breakfast Club for today. Again, the only question is whether this rise in oil is short-term headwind or a longer term. The case that I built last week for removing the ability for Iran to continue to threaten oil in this Persian Gulf region, something that's not really getting a lot of play right now, but that could be an underlying outcome of this conflict that on the positive side. And the long-term thesis for AI is still intact. So that will be Breakfast Club for today. Be careful with your trading. Market's still expected to open in the red. Might see a little bit of a bounce, though. I think I just call it a hunch. Oil pulled back below $100 a barrel early this morning, traced right back up above. But if we see a pullback below $100, I would not be surprised to see the markets rebound just a little bit. So we may go down and then come back up. Just have patience. So I'll be hosting the AI Wealth Conference March 20th and 21st. This week, I'm preparing for that, so I will not have Breakfast Club for the rest of the week. I will be back with you next Monday at the usual time and live, since I double-checked my calendar, and I do not have any other doctor's appointments, et cetera, scheduled for next Monday. So apologies for the pre-recording, but thanks for bearing with me. I hope everyone has a good day and a better trading week this week, and I'll see you next Monday.